So in today's video, we're going to talk about Beijing's economy. Now, have you heard any news lately about a massive economic collapse? Okay, what about a huge meltdown in the Chinese financial markets? Well, actually, there hasn't been any really at all. And yes, there are some very big problems in China's economy, but it's not quite the doom and gloom that many people would like you to believe. Now, let me start by saying that there is definitely cause for concern. China's economy is going through a rough patch right now, and if you live in China or depend on trade with the world's second-largest economy, then it's wise to be cautious. However, we should avoid sensationalism and instead focus on facts. So here's what's really happening in China's economy. First, let's look at some of the headline numbers. China's gross domestic product, GDP, grew by only 3% in 2022, which is a sharp slowdown from the blistering pace of 14.7% in 2021. And even worse, the International Monetary Fund, IMF, projects just 2.9% growth for China this year, which would mark the slowest economic expansion since the Asian financial crisis in 1998. So this is hardly what we would consider collapse, but it does paint a pretty bleak picture, especially when you hear about all the bad news coming out of China. There are several key reasons for this slowdown. First, China's real estate sector has been in a slump for over 2 years now. After a series of regulatory changes aimed at curbing excessive borrowing and risk-taking among property developers, the housing market has softened considerably. In fact, one analyst firm estimates that the residential real estate sector will continue to shrink by 10% in both 2023 and 2024, which means that if true, China's economy will continue to contract this year and next. Second, Chinese consumers aren't spending much money either. As the old saying goes, business is driven by consumer confidence, and without that, companies won't invest, expand, or hire new employees. Now, this is a problem because consumer spending accounts for around 60% of China's economic activity. So if people aren't buying stuff, then the entire economy slows down. The result is a vicious cycle where falling incomes, rising unemployment, and stagnant wages lead to less consumer spending, which leads to lower profits for businesses, which in turn leads to more layoffs, and so on. And third, China has been dealing with weak export demand from the United States and Europe, which together account for around half of China's total exports. Global demand for Chinese goods is simply weaker due to slowing economic growth abroad. And don't forget, China is very dependent on exports. They account for around 20% of the country's GDP. So weak global demand is having a significant impact on China's economy. And finally, China has been dealing with some serious deflationary pressures. In other words, prices have been falling for months. Consumers can enjoy lower prices on everything from food to electronics. But this isn't necessarily a good thing. When prices are falling, businesses are making less money. And when businesses make less money, they produce less, which means that the entire economy slows down. To make things worse, this is creating a vicious cycle of falling prices, falling production, and falling incomes. This is what we call a deflationary spiral, and it's something that the Chinese government is desperate to avoid. Okay, so those are some of the key challenges facing China's economy right now. But how is the Chinese government responding? What's the outlook for the rest of this year? And is this really a sign that capitalism has run out of steam in China? Well, first, let's talk about the government response. Beijing has taken a number of steps to try to boost the economy. For example, the government has issued $1.6 trillion in special bonds to fund infrastructure projects. And this is designed to help prop up the construction industry, which has been hit hard by the real estate slump. The government has also worked to increase liquidity in the banking system. This should encourage banks to lend more money, which should help businesses get the cash they need to grow. Additionally, the central bank has cut interest rates and relaxed other monetary policies. This should make it cheaper for businesses to borrow money, and this could help kickstart economic activity. Finally, the government has announced plans to help local governments take on debt. This is important because local governments play a big role in China's economy. They account for around 40% of total investment, and they've been under a lot of pressure due to the real estate slump. If the government can help them take on debt, then they'll be able to keep investing in infrastructure, and this should help prop up the economy. But will these measures work? Well, that's a tough question to answer. On the one hand, the government has already spent a lot of money propping up the economy, and so far, it hasn't really worked. Additionally, the real estate slump is still ongoing, and this is a major drag on the economy. On the other hand, the government is continuing to loosen monetary policy, and this should eventually help boost lending and economic activity. So it's really too early to say whether or not these measures will work. Okay, now let's look at the long-term outlook for China's economy. Again, this is very difficult to predict. The IMF expects growth to pick up to 5.2% in 2024. However, this is largely based on the assumption that the government will continue to loosen monetary policy and boost lending. If they don't, then growth could be even slower. Additionally, there's a lot of uncertainty surrounding the real estate market. If the slump continues, then the economy will continue to suffer. However, if the government is able to stabilize the market, then growth could pick up in 2024. So basically, the outlook for China's economy is very uncertain. There is a lot of downside risk, and this is why it's so important to monitor events as they unfold. So what does this all mean for investors? Should they stay away from China, or is this a buying opportunity? Well, this is a difficult question to answer. Obviously, there are a lot of risks to consider. China's economy is slowing down, and there is a lot of uncertainty about the future. However, this is also an opportunity to buy into China at a discount. The Chinese economy may be slowing down, but it's still growing. And that makes China different from many developed economies which are actually shrinking. Additionally, the Chinese stock market is down around 20% over the past year. So there are certainly some attractive valuations. In the end, the decision of whether or not to invest in China is a personal one. There are clearly some risks to consider, but there are also some potential rewards. That is why I think it's important to monitor events as they unfold and to be prepared to take advantage of opportunities as they arise. As always, thanks for watching.